Hey everybody, welcome back. 4630 seems to be our key level. That's going to be the level that we're going to watch as our new resistance. That's definitely something that we're going to pay attention to, and we should all be able to see that right there. Now the issue is, what do we do going forward? What levels have we cracked? And we're going to get into that. You can see this 4480 there, and you can obviously see these little points there as well, but let's just drop a line and go from there. We have to talk about institutions, what they're doing. We have to talk about what insiders are doing in certain sectors. It's pretty fascinating to me. Hopefully you'll find it fascinating, but there's a lot of structural changes that went on this week, and we're going to drill into the weekly charts, but we're also going to expand out. See how you're running into this and then you're just rejecting, and everyone's just expecting the same thing to happen again, which is just you reject an area, pull back and go. There's some signs that that is not what's happening here, and we're seeing rotation in the sectors, which we will get into as well. But most important, the question is, what do we do now with what we have? Well, the very first thing that you should be able to see is a level right here at this 45.63. It's really 45.60, and we're going to drill into this in a moment. But before we do that, see how you're just dangling right here? There's a reason that you've been closing at the same spot for 3 days. Now, if you really look at this, you closed at 44.85, and then the next day we're closing at, guess what, 44.85, and then the next day we're closing at 44.80. They are starting to walk you down a little bit here, and you've had other closes that were 4,500, but now they're walking us down. Now we've got this doji on Friday, and we should talk about that doji and why it's there. To start with, what we're going to notice, and we'll clear up all our lines and we'll put them back in a moment. What we're going to notice about this chart is I use a 12, a 22, and a 55. They're SMAs. You should use whatever you're comfortable with. I can't make that clearer. You should use whatever you're comfortable with. Now, if you here, you can see that we have a 12-22 cross. People will say, well, we had one here before. It was very different. It's very different because we're not off a base. You were in a base. You were still trying to get through a neckline and form. You have no base up here. These become more vicious. Not only do they become more vicious, do these here when you're breaking these RSIs. Now, why is that more vicious when you're breaking the 50 there than when you broke the 50 here? Very clearly because you have a negative divergence right here. People always love to say that RSI is that lagging indicator. It's a lagging indicator if you're not using it for divergences and you're not really familiar with how the indicator works. But it can actually be a leading indicator and tell you, hey, something's up. You just don't have an exact date on it. But you can see this throughout your charts. But if you look at this, how you're rising here and the RSI is dropping down, it's telling you that it's coming. The confirm of that move is here. When that cracks, boom. And then you break 50. As I've gone through this before, and I'm not going to waste a lot of time on it, you guys all know these videos are connected. If you are new, all these videos starting on Saturday are connected throughout the week. We follow them through the week. We actually have a game plan. They're all linked together. Now, if you take a look at how this is playing out here, once you break that 50, you're what? You're hosed. That's it. You're going to start seeing underperformance, whether it's a sector, index, or stock. If you keep that as a guideline, it will save you a tremendous amount of money. We have a 12-22 cross. Why are we starting to get rejections here? We're getting closer and closer to the 55. 55 is the institutional, let's call it demarcation line, where they're either going to support it or they're not going to support it. That's why you see the most vicious moves, not on a 12 break or a 20 break or a 5 break. The most vicious moves of any stock happen at two spots. Number one, they happen at the 55. Number two, they'll happen at the 200. Now, here is the ES or S&P futures on an hourly chart. Now, what is this telling us? All they're doing is spiking us up to knock us down, spiking us up to knock us down. You should be able to see this pretty clearly if we put this up here, and you can clone these to get the same trajectory and see where you are down here. And you can see a pretty clean level. Always clone these lines. You want the same trajectory. You know that you're what? You're bonking along that lower channel. You just want to know that when you get down here that you're going to possibly, continue to bonk, and that works until it breaks one way or another. It's very simple. Why do trend lines in these channels work? Because institutions are basically selling a certain percentage or buying a certain percentage every single day. That's all you're doing is charting behavior. That's all technical analysis is. You're charting human behavior. If you come over here, and we start with where we were, as I said earlier, that all these videos are linked together. You remember last week and the week before, we were talking about the development of this head and shoulders the week before. And then last week, we were talking about the head and shoulders breaking here on Wednesday, and you can see the break. And we should be able to see this head and shoulders, but we'll just pop it in real quick. where you have your left shoulder here, you have your head here, and you have your right shoulder here, right? Left shoulder, head, right shoulder. And I think that's a really important distinction. Now, you know you have a neckline, you know you rallied to your neckline, you know you failed at your neckline. We all know what happened here when Japan came out and said, hey, we're going to raise rates. We all know what happened here. We all know what happened here with CPI. We're starting to see macro play a bigger part in the market than it was playing previously. For a while there, nobody cared. All of a sudden, it's starting to rear its ugly head. We're going to get into why that might be. But what we're seeing here is we're seeing this pattern develop and we're unable to break. If you take a look at this, it is becoming abundantly clear. I'm going to give you two really quick tips. I use this cloud system. It tells me which way we're heading and why we're heading that way. I can determine it by the short-term cloud or the long-term cloud. For our purposes, I'm going to leave the long-term cloud in. Let's get rid of that. And when it goes from green to yellow, it just means to me that, hey, just pay attention. And again, I don't know if I'm getting this. I don't know if I'm getting this. If I act on the cloud here as a trigger, like a be-all, end-all, it does not work. If I act on the cloud here as a be-all, end-all, it worked. If I acted it on here as a be-all, end-all, it worked. It's one data point. Now, if you take this data point, and this is something to pay attention to, and I overlay another data point with it, then the probability of me being right increases. Now, the other cloud that I have up here, just for sake of argument, and I do use this app, and obviously I work in some of the things that I use and some of the things that I think are helpful. And I did a whole video on this. You can actually find it. It's probably the most popular educational video I did. But if you look at this, the cloud, okay, this is cloud. And it's going to have a very similar pattern to something that I'm using. You'll see what I'm using. The cloud that I use is a little tighter. If I click off of this really quickly, you'll see that my cloud's a little tighter. Theirs is a little wider, and theirs is a leading indicator. It leads forward, and I can show you exactly how this leads forward very, very quickly. But for our sake, we're going to take off this cloud and focus on this one for an hour. All you want to know is that if you come to this point and you come across to here, you will notice that this is usually 26 bars out. Okay, it is at 26 bars out. It's taking this particular pattern from these two data points. I'm not going to get into all of it. And it's connecting you out and it's giving you an idea of where you're going to be 26 days out. This is telling you very clearly by 26 days out that we're going lower. That's what this is telling you. It's telling you if you're going to ride this cloud down, and you can see that flip right here, and you'll note very quickly here, you probably already noticed it, how the cloud that I'm using gave a signal before this cloud. And the reason for that is it's just a faster trigger than what's going on here. It doesn't mean that it's more probable. It just means that it's faster. You can see how you're coming down here and you're trying to hold, right? And every time you get through this cloud, Ichimoku cloud, it's doing what? It's having a really tough time. Every time that you're riding this cloud up, what's it doing? It's holding that cloud, and it holds it until it flips, rallies, flips. Also, the direction of the cloud matters, and you can see that this is telling you something. Well, when you start to see this and you start to break below the cloud like you did on the other one, you want to pay attention. Overlay both of these at the same time, and you get a much clearer picture of what's going on, and you can start seeing some of the issues that you're having. I think this is really important for a couple reasons. It allows you as an investor or trader to get a better picture of what's going on in the market. Now, if you look at that, you might not trade off of it, but it should tell you which way you're leaning. For example, this week in our community, everybody that's talking about, oh, I want to go long, I want to play these bounces. I was not playing the bounces to see if we were going to go high. And the reason for that is it was very clear to me by a lot of the indicators that I use that we were not going to bounce. And you can see quite clearly how the week played out, and we didn't. Now, if we start looking for levels and how this is going to play out, I don't know if we're going to break the 55 or not. I can tell you this, I'm spending a lot of time on the ES for a reason. You're going to see right in here, 44.20. We need to hold that 44.20 level. If you don't start holding those levels, it starts becoming a long way down. You start looking at this 43.29. You start working your way down to all these different levels where you have some support, 4,200. Can this happen? Yeah, things can always get worse than you think they can. Now, we could talk about why this could be happening. Could be sovereign debt. It could be sovereign debt of the U.S., that downgrade, that it's going to come from other places. It could be Moody's downgrading the regionals, even though I don't think it is. There could be several reasons why we're thinking that this could be it. I do want to go through one very, very quickly so that we get it. CPI came out this week and it was decent, meaning it came in line and parts of it were actually lower than expected. That dropped. Now, if CPI drops and then PPI came out, and PPI was higher than expected, meaning we're expecting a drop in PPI, and instead of that drop coming to here at the same level, our PPI drops to here. Well, the issue with that, as we were explaining in one of the live pre-market videos that are public every morning, is that when you're doing this, the profitability of the company is going to change. In other words, PPI is what the corporation pays, CPI is what we pay. I always use the analogy of a burrito. If it costs them $2 to make a burrito and they sell it to us for $4, then that profitability is $2. If it's going to cost them, $2.50 to make that burrito now, and they can only still sell it to us here. And what this is telling you, quite frankly, is this is telling you deflation. What it's telling you is that the consumer is only going to pay so much, even though the costs are going up, which means the underlying demand for product is going to be less. That could be another reason we're starting to see weakness. Are we going to see deflation? There's a bunch of very smart people out there that are saying, yes, we are going to see deflation. And China's already going through it. I'm not going to waste an inordinate amount of time on it. There's so much to go over here, but I do find that interesting. For our intensive purposes, we must watch the levels we went through. We must watch how we act at this 55-day moving average. You can use a 50 if you like, but we must watch that. We must watch 44.20. And then we just must be aware that if we start breaking those levels, they could really start walking us down here. And we're going to get, when we start looking at the insider trading, you'll see a couple of really interesting things that are developing that are leading to me thinking that people are thinking that. But let's get into the Nasdaq. Now, the Nasdaq usually leads. And if the Nasdaq is cracking, it usually means the S&P is going to crack. So I'm going to say that again. The Nasdaq usually leads. So the Nasdaq is cracking. It usually means the S&P is going to crack. Now, we have only closed below the 55 now, this one time. It does not make a pattern yet. You start closing below this 3 to 5 times, you start developing a pattern. The 1222 will come down. I want to be very clear about this on how significant this move is. You can see it's happened here. You can see that we've touched here. We've touched here. See how you broke once and then flipped. Okay, you came back through it. That's why I always say it takes 3 to 5. You have not gotten to a point where you have stayed below it for any period of time in all of 2023. You do not want that to be now. We're going to have to watch this level extremely closely, and that puts us around that 50.95 level. And we were not able to hold above that when we start drilling into the daily here. You were not able to hold above that level. And if you drill into this in the weekly, just very quickly, and you look at the weekly, which I love looking at weeklies, there's a couple things here. Number one, I use RSI for divergences. There's also some other things that I use, and I'm not going to get into all of them, but if you look at this right here, you do not want to break 70. Anytime that you're above 70 and then you break 70, you start to see weakness. It does not mean that you're going to completely implode. It's very rare for it to happen, but it does mean that you're going to have a period of underperformance. I don't think it's rocket science. I think you can all see how this played out, when this happened during these periods of time, where you can see exactly what I'm talking about if you just correlate it to that move. So in other words, over 70s, okay. You could actually use it as a really fast buy trigger, depending upon the time frame. But when you break back through 70, you want to pay attention. And again, this is not really that hard to follow. I want to be very clear about this. Break above the 50, guess what happens? You rally. I go through this ad nauseum. Okay, try to break above the 50, but can't. You get a little move higher, and then you fall down. Tries to break above the 50, and it can't. Get a little move higher, and then you fall down. Guess what happens when you finally stay above the 50, retest, you get the greatest move that you've had probably in 2 years. It's not that magical, guys. It's pretty simple, especially when you start understanding what RSI actually is, determining the magnitude of the move. You just want to use these demarcation lines, and you don't have to even use it as a trigger, but at least allow it to give you an understanding of where we are in the market. Now, some of the other things I use are rate of change, which I went through about 2 videos ago. Maybe we'll do it later in the week. I'll go through rate of change, but we just have too much to do. We could see the rejection of the 55 right there. We can see right here, and I'm just going to use the weekly here so you can see this. You can see it right there, the rejection there. Does that mean that that's where we're heading? No. What it does mean is that we have to look at some of these key levels. Yeah, I use those wicks. We're through the wicks. And I have to say, okay, well, where is that going to put us? Well, for me, the very first thing that I would look at is I would try to find a control bar. You have this control bar right here. Now, control bars are bars to me that are in control. We have never got over this break. Why is this a control bar? This is a control bar because of this. So if I just come across right here, and I draw my line, you'll see a trend. When we broke that trend line, what happened? We never came back. Nasdaq weekly, we never came back, ever, since you broke that in January 22. So I keep this as a trend line, and I keep the top of that as a control bar. And then you come across from there, and you just draw a line. Isn't that convenient? This bar's in control. And that's how I view it. And it just makes my life very simple and go, well, I got to the control bar and I rejected at the control bar. 15,625 is the top of that control bar. We rejected there. Therefore, that level is what? That level right here is going to be resistance. And that's something that I have to pay attention to. Okay, so that's resistance. But we're cracking there, unable to get above it, just like you were unable to get above it here. Then we just have to kind of walk ourselves down and go, well, where's the next level? And you go to the top of these wicks, and you go, well, we broke there. Okay, well, where would be the next level? Well, this could be construed as a breakout because we got above this level. That puts you at like 14.6, which seems pretty realistic for the next text. Now, if you break that 14.6, you really don't have a lot going on here until you get to about here, this 13.7. And that's definitely a pretty interesting area because if you come across here and you just drop this, and you'll see a couple battles going on right at that level. You'll see a reversal off of that level, a battle right here, and then you'll see a little battle over there. The 13.7, 13.6 level looks like it's going to be next. And we're not seeing anything here at all that would make me think differently. Now, if we take a look at the Nasdaq, we should go back. Let's just go to July. We'll go back to July and we'll look at that. All right, now, you don't really have that head and shoulders, but you have this pattern that we've been talking about. And what you have is you have this fan-like pattern where they are just very simply walking you down over and over again. And any time that you've tried to break above that pattern, it has not worked. You can see the fan, right? So in other words, the angles are walking us down. If we're being walked down, the chances of us getting through that, all these become points of resistance, all of them. And you're on an hourly now, it's a little shorter term, but they're there and they need to be respected. So now we know we have that. We could say that you have a support line right here. I'd have a hard time calling it a neckline. We're splitting hairs, but I mean, I don't really have a left shoulder over here. I guess we could make this argument, but it is what it is. So you can see the rejections in here and how we're doing, and you can see how they're walking us down. All right, well, if we just go here and look, where are the levels? Just forget about the moving averages that you have to hold on to. Well, you'd have to hold on to that 15.1. Well, you're hanging on there by your fingernails. And you're rallying up and you're breaking down super fast. And that's not what you want to see. You want to see consolidation and then moving higher, right? You don't have anything like that. You have these spikes. So then you go to the next support level, which gets you to 14.8. And then you realize that if you break 14.8, well, that's going to take you down to here. That's going to take you down to 14.6. These are all levels of demarcation that we want to watch and then see how we act there and then make more informed decisions. I do think that people need to take one really big caveat away from all of this. This is day one, what happened on Friday. Okay, this is not, have we been setting up? Have we been weaker? Yeah. But this is a structural change to the market. When you are below the 50 here, and you have not been below the 50 since March, and quite frankly, even then, you were nowhere near as below as you were over here in 23. So then you have that, and then you're breaking here on the 55. These are structural changes that are going onto the market. So we could say anything we want about NVIDIA's earnings. I could talk about that I still think that we could be at all-time highs by the end of the year, which quite frankly, I still think that's viable. I do think I'm missing something on the deflation and the sovereign debt side. There's some other issue out there that is causing panic. And the reason I think that is because we have really good companies that came out and crushed earnings and raised expectations, and they're still coming in. So I'm missing something, but we'll get to that. So if we look at that here and we see how we're hanging in there, we must look at that level. Now, this is the SOX. If the SOX doesn't lead, it's just like financials for the S&P. If the SOX doesn't lead, it's very hard for the Nasdaq to be sustainable and then to lift. We've been talking about this for a while. One of the key things that we were pointing out, and I think this is pretty telling, but one of the key things that we have been pointing out here is just, again, and I really want to hammer this point home because I see a lot of people talking about that RSI is a lagging indicator, and quite frankly, they just don't understand it. And the reason they don't understand it is just because they either haven't put the time in with it or they just have a self-belief. And maybe for them and the way they trade, if they're day trading, maybe it doesn't work for them, and that's fine. There's a reason why there's so many indicators and they're open to interpretation. But when you start to see this and you start to see that the magnitude of the move is dropping, right? And the magnitude of the move is dropping and then we're going higher and higher and higher, that is not sustainable. it doesn't mean that it's going to drop on a Tuesday, right? It could take months, just like this took, but it's not sustainable. It's sustainable if it comes down and then course corrects and comes back. But when you start making lower lows like you did here, well, this was glaring. I mean, I put an SOXS trade on. I'm doing quite well with it. Now you broke the 55 the day before. And that's all I needed to see. But this is a precursor usually, and listen to this really carefully, this is a precursor usually to what the Nasdaq is going to do. The SOX is usually leading the Nasdaq to some extent on what it's going to do. And if you think about that, it makes sense because the Nasdaq is tech laden, very well is. And then on top of it being tech laden, we also have to understand that the other way. We also have to understand that NASDAQ being tech laden, we also have to understand that the biggest drivers of growth are semiconductor chips. So they're cracking. This is cracking. This has a lot of work to do. If you got rid of all my indicators here and we got rid of everything and then we just looked at this, all right, so maybe you hold here. But you would have to argue that, well, we closed at the low, forget that this is even the SOX. We closed at the low, we closed at the low. I'll say it again. We closed at the low. Well, you better hang on to this doji here. Because if you break 80, you have to start realizing, well, now you're going to 72. Okay, well, then we're going here. 66. Right? I'm not going to speculate and say, NVIDIA is going to miss earnings and AI is going to take longer than we think. And all. I'm not going to get into that. You can see your angle right here and how you broke. What you can always do is you can always clone these and then just kind of see if they fit somewhere. And if they do, maybe that's something to pay attention to. So you can see that right there. Didn't even cost you $1,500 to take a course. Now you can see that you're cracking right there. And you can see this 482 right in here. And that you're heading to this 466. If you break that level right here, and we're not even looking at the indicators that give us, quote, another piece of the puzzle, right? That's what the indicators do. They don't give us, the full puzzle, but they give us like the edges. So we're looking at this and we're rolling. Go take a look at this on a weekly. Does that look like any kind of chart you'd be rushing into? Or does it look like you're forming a new control bar? Because you couldn't get above the old control bar. Remember the whole control bar spiel I just went over? Now you're up here, you reverse. Okay, and now what do you have? You have another control bar. You have another area and you're breaking down here. Well, what happens when you break a flag? Where's your target? Your target is usually the open or low of that flag. Let's just use that. Okay, that puts me there at 428. Now, I don't know that you're getting there. I would make the argument that you're probably not getting there and that you're going to come to this neckline, and I'll show it to you. So you can see your neckline right here, and you can see the inversion of this neckline on both sides. What do I mean by that? You should be able to see this, but here you have a left shoulder, here you have a head, here you have a right shoulder, here's your neckline you cracked, here's your control bar. Okay, everybody gets that. Then at the same time, here's your left shoulder, here's your head, here's your right shoulder, here's your neckline. Okay, that neckline, here's your control bar. Here. So that's where I think you can get to in this area. And I think this 430, 431 area, it's called 430, make the math simple. I think that is your major support. That is a very strong demarcation line. I'm not so sure that you break that. You're going to need something big. You're going to need like NVIDIA missing something really big to drive that down to that level. I mean, it's 10%. That's a big move for me in semis. Realize that you go by what's called rule of 3. In other words, if we break down 3, so if you break down 1% here on the SOX, then the underlying securities that are leading will move 3 times that. So if for example, if the Nasdaq breaks 1%, the SOX should break 3, and then one of the names in the SOX will break 9. It's kind of like a rule of thumb on how it works, just from history and just based upon the way that the movement has been. But we want to watch this and we want to see very carefully how that's playing out. But we don't have any leadership at all. You see cloud names, they're trying to get through this neckline, and you should be able to see this neckline right here, but I'll just draw it out so that we can see it, and that way we're not playing around with it. There's your left shoulder, head, right shoulder, neckline, and then what's happening? Trying to get through, it looks like we're rejecting. So you need to hold here. You need to hold here on cloud. I think that this is pretty telling because you just you have no leadership. And not only not have leadership there, you're watching tech completely implode. I'll show you what I mean by that. So if you come here and look at tech, and this is the tech sector in the S&P, we've already cracked. We've already cracked. We're just not dropping fast, but we've already cracked. We're already 3 days under here. So this tech sector usually leads semis. All this stuff's connected. Why? Because these are the big guys. And where do people put their money? If they're institutions, they put them in the big guys. Why? Because of liquidity. They need liquidity. They need to be able to get in and out. I mean, imagine a $20 billion fund trying to get out of AE8. It's not going to happen. A $20 billion fund can get out of Microsoft in a minute. It makes a huge difference in their decision-making process. And you can see how ugly Microsoft's getting here. It's getting absolutely really, really bad. And that takes a while to rebuild. You just don't just go, oh, we're just going to go higher. It doesn't work that way. This is something that we must pay attention to. Apple, I'm short. I continue to stay short. I don't really see any reason to change my opinion there at all. I will say this about Apple looking at a weekly, and we're going to dive into the stocks a little bit greater here on the weekly in a moment, but I do think we should go through corporate insiders first. But you can see very clear here how you're breaking down on Apple on the weekly chart and how you broke that 70 here and how we're responding to that. And I think that when you start connecting all this, it starts making a lot more sense. If you start going through some of the sectors as we did there on the weekly, you start looking at the financials, they're not really lighting the world on fire. A matter of fact, if you take a look at this, and we see how we're acting here. There's your control bar. You can't really get near it, can you? You're starting to reject there. Now, we could make the argument that this is some kind of what? Maybe it's a cup. Not really. It's a pretty ugly cup, right? But you can make the argument that you're forming that hand over there. I'm not sure. What's starting to bother me about it is we're already developing some precursors that we're going to roll. Every single chart I just showed you started with a 1222 cross. Every single one, 1222 cross. Okay, that's how they all start. That's how it starts. That's why you put the pieces together. If you break the 1222, what are you doing on RSI? Am I above or below it? All this stuff's connected, okay? And the more data points that you get that are actually data points, meaning that they actually will sway the weight of the movement, the better you'll do. Anyway, you see this right here, you want to pay attention to that. I think you can get down here to that 55. What you do with that is up to you. I still like a lot of the regionals, and you'll see why in a moment here. But if we just take a look at some of these other indexes, this was really nice to see, and we're seeing a lot of nice corporate response to that, which I'll show you in a second. But it was nice to see that we actually, even if it's a defensive sector, that we're seeing money come into the market and buy equities. And we did see that on Friday. We just didn't fall apart. If every sector is falling apart, as I mentioned Thursday, remember I said all these videos are connected. What's important about this is I don't want them to just abandon all equities. That's when it gets really scary out there. And I thought we might be heading that way, but I'm starting to see signs that we're not heading that way. I'm going to get through a bunch of names here in a moment that I do think that look like they're worth paying attention to. But if you start looking at XLY, same thing, you have that 1222 cross, but you are seeing bright sides. For me, XOP is the one sector that I am looking at and I am adding names to, and I'll show you some names here. But I want to get through the corporate insider stuff first and show you what smart money, dumb money's doing, because that's really important for you to understand where we are. But you see how you're closing right there? I have a new closing high. I'll take that. I have a new closing high with the market doing what it's doing. So you go and take a look at this on a weekly. I mean, you should be pretty happy here. Now, if you look at let's clean all this off, and you look at the longer term side of this and use the top of this doji, and you come straight across to here. And what do you have? I have a DTL break. Now, I'll take that all day long. Now, what else do I have here that would make me interested? My RSI is above 50. There are things I use. If you find no value in them, don't use them. But you see these DTLs right here, and you see how you're breaking right here. That's what you want to pay attention to. Your next level you have to get up to is you're going to get up to 61. And that's really what we're doing. So there's some names there. This is something that we're in. We're up several dollars in it, and I'll get into some of these names in a moment. But I do think that the more important thing for us to focus on is not only just the indexes, like looking at what's going on, but let's get into some of these sectors and let's look at what corporate insiders are doing. Now, I'm a big believer in looking at what the insiders are doing. And there's a couple different things that we look at besides just looking at the technical charts. One of the things that we always want to look at is what are insiders doing? The way the world works in trading and investments is very simple. Just remember this. It starts with insiders, and then it starts with institutions, and then it starts with retail in that order. And you just think of it that way. Again, you just want to focus on the insiders, and then you focus on the institutions, and then you focus on retail. It's that simple. No one knows their business more than the C-level suite people at these companies, period. It's just a fact. This is going to tell you buy-sell ratio. That means you're going to take the buys divided by the sells. You're going to come up with a ratio for XLF, which is financials. And what we're going to see here, I'm only going to go back 10. because that's really all we really need here. But if you take a look here at 16, we had a little hiccup here in the financial markets. When that happened, it wasn't a big one, but it was a little one. And when that happened, what did we see? We saw them step up to the plate and buy their companies, and they did exceptionally well when they did that. This obviously was the global pandemic, and when all the banks got crushed, they stepped up and bought all the banking stocks that they could, and that gave us a very high buy-sell ratio. What are you seeing right now? What I would suggest is that if we look at this and we look at our level and we just draw a straight line going across, you realize you're at the second highest buy-sell ratio in financials that we've ever had. Now, corporate insiders, this one was interesting as well, XLP. What was interesting about XLP is that's staples. Think Colgate, think Procter & Gamble, think Clorox. And the corporate insider buying here of consumer staples is kind of an interesting time to do this. Just look at the past 5 years. You can see right here, by the way, these charts are from Sentiment Trader. I have spoken to them. It's okay that I use these charts. But they have a pretty good service, and that if you were interested in getting it, I have no affiliation with them. But it just gives you some pretty good data. Anyway, see this level right here. If you just took at that level and go, well, where were we here before the past 5 years? You'd have to go back here. Now, if you go take a look at this and you go out 10 years, this is what we're going to get. 15 years, this is what we're going to get. That's as far back as we go. We go back 13 years. Why is that important to see how far back we're going to go? Because I found this fascinating. We take that level there and you come straight across and just look at the angle here. And just to not confuse people, I'll just make this a line so people don't get baffled. If you take a look at this coming straight across, where were we last time we were here? Well, this was before the pandemic, that insiders had a high buy-sell ratio of XLP, which is kind of an interesting time for that to happen. But nonetheless, why are insiders not selling their companies right now, and why are they buying their stock, and why is this at the highest level? What's interesting about this data is it makes you want to try to figure out what they see. In other words, you buy staples when it's time to be defensive. And why are corporate insiders stepping up now and buying the defensive names? It's kind of an interesting time. I know at the financials, what we just went over, they got really beaten up on regionals where we thought every regional bank in the world was going to go to zero. That I get. This I don't understand, and I find it very interesting. One of the top levels of corporate insider buying in financials is now. And why I'm showing this, even though we've already showed the buy-sell ratio, is I just want to show that it's not just the lack of selling that's driving this. It's the buying. We're seeing buying. And the fact that you're seeing buying now while the market's doing what it's doing, it's a very interesting time, to say the least. And again, you just equate this out to a 16 and the pandemic. But what's interesting about this is the ratio is not going up because they're not selling. The ratio that we just went over is going up because they're actually buying. Their respective insiders are buying those respective banks. And I find that very interesting. Another sector it's worth paying attention to, I always look for these anomalies and try to find like extreme readings, and this is a pretty extreme reading. This is corporate insider sells, meaning are energy executives, XLA, are energy executives, are they selling their stocks right now? And you can see where they were selling previously. You can see where the XLE was when they were selling. And you can see when they aren't selling here. You can see when they were selling, and you can see how we acted, and you can see when you cross this line what they're doing. Now, what I like about this is we broke this level to an extreme reading recently. We broke to an extreme reading where they are not selling. Energy names, the fact that they don't want to get out of the energy names as the energy names are rallying, to me is very telling. If we saw some kind of sharp move like this with the way energy was rising, that might be something that we want to look at. We're not seeing that. We're seeing energy just kind of truck along, and as it's grinding higher and some of these names are going higher, they're still not seeing any selling. A matter of fact, they are greatly below any metric that would even suggest that they're selling. I think that this is significant and something to pay attention to. If you kind of look for the outliers again, I mean, you're going to have to take this with a grain of salt because it was the pandemic. And obviously, that's going to give you an extreme reading. It's going to give all this stuff an extreme reading. You almost want to take it out and look at the data without it. And if you do that, that's fine. I mean, there's no harm in just coming across, drawing a line, and seeing how unusual it is to be below that area. And quite frankly, the only time you were ever there was the pandemic. Besides now, you have a couple little spots like here, but for me, these kinds of areas, they're kind of hangovers from some of this. You're going to have an extreme opposite and equal opposite reaction move here. They're kind of situations where they're going to happen because this happened. Some people are going to get out of position. You will get some extreme moves, but I do like where this is, and it does make me want to pay attention to energy. I thought this was interesting as well, and this kind of fits along the same lines as XLP, because it's a defensive play. It's just the opposite side of it. In other words, when I say opposite side, what I mean is corporate insiders are not selling any healthcare. They're just not doing it at all. Matter of fact, if you look at where we're at on the healthcare spectrum, and you take a look at this area right here, this is the lowest amount of corporate insider sales that you have in healthcare in 10 years. You don't even have anything registered for it. I'd have to go back 15, 20 years. It's really not going to even be comparable to where we are now. And I think that that's definitely something that's worth paying attention to. If they don't want to sell their stock, there's a reason. Why don't they want to lock in some profit? Doesn't make any sense. When you start to see these kinds of outliers, you can see, I mean, if you were to draw these and leave these here, and I'll give you an example what I mean by this when I say outlier. So you come here and you say, okay, well, the majority of us are in this time. That's not going to work. I'm not going to like that. Let's do it this way with the rectangle. And if you look at this rectangle right here, the majority of us are up there. And you go, okay, well, so that's something. Now, and then you kind of say, okay, well, we were here a couple times. And then you kind of look at where you're at right now. And that kind of, when you do this, it kind of, and you put things in quadrants, it kind of puts it in perspective. Like, this is such an extreme reading. And you could see here how they were selling, here how they were selling, and what happened there. And I think that's a really important distinction. You could see right here how they were selling, and then what happened? Well, we kind of pulled back in the XLV, and then we went sideways. And you're seeing that from an area where, okay, well, now look at us. And we're still at the highs, and they're not selling? Well, what is that telling us? Because it's telling us something. Maybe they see something coming down the pike, but I find this very interesting because it ties in with what's happening in the staples. Now, if I show you this graph, which I'm going to, obviously, and if you like it, please comment, let me know, and I will work this into rotation, and I will show this and follow up with it. This is glaring, and this is something that's going to require an explanation. This is the RIDEX total leveraged bull bear ratio, and what it does is it measures RIDEX funds, bull and bear, and creates a ratio with it. It then sets standard deviations alongside, and you can see where you're out of that standard deviation on a 1-year chart. Now, I want to be real clear on what you're looking at. The one thing that I think people really get wrong is not understanding the data that they're looking at and what it really is, because then you can make a better decision. Extreme values, the green dotted line is a 1 standard deviation above the 3-year average. The red dotted line is 1 standard deviation below the 3-year average. Okay, green, 1 standard deviation above the average. Red dotted line, 1 standard deviation below the average. The higher the range, the more people believe when they're buying these levered bull funds that we're going higher. The lower the range, the more they believe that we're going lower. And you can see that we're sticking out on this area. And now let's just kind of talk about the importance of this little area, because people are going to look at that and say, well, that's nothing. And now let's just put that little level there in context. Let's go out 3 years. And I want to show you this because I found this pretty fascinating. And I do think it's something that we should follow up on, but I'll leave it to the comments. It is very difficult to equate what happened here. This is when everybody was rocking and rolling and thought everything was going to be great. And the reason I say that is because it's really hard to use this data that was really kind of, I'm going to say, quote, false, because the Fed injected $1.7 trillion into the markets. Everybody was buying everything. That's when people were buying JPEGs and calling them NFTs for $1 million a piece, and everything else. Right? And that's just because you were just playing with house money. Money was very free flowing then. If you start getting into when we start realizing that inflation's a problem, and you start using this, and this is where the Fed stopped injecting capital into the bond and equity markets here. And you look at those rallies over there. I think that is a good spot to use versus using something like this. And then I think if you come here and you look at something like this, you realize that in 3 years, you really have been over here and you really have been over here. Now, we're going to take a second here before we go any further with what I'm going to explain and say, okay, This is where we are, and then what happened there. Now, for any statistical significance, for there to actually be statistical significance, you need 30 data points, right? To have a statistical significance, we don't have 30 data points. This is what we have. So we have to deal with what we have. Right? That's really all we can do. Now, if we go back 5 years, okay, well, we have all this nonsense again. You have where you are right there, and then we would have this other little spot that you can see here on the market there. And that little spot in and of itself, if you just kind of equate it here, for time's sake, we'll just do it this way. You should be able to see how you kind of sold off down there. It's not telling you that you're going to have a major pullback, but what it is telling you is that you need to pay attention to this area. Now let's go back 10 years. Now, to put this into perspective, we go back 10 years, you can see you're over here, 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 and here. You have 4 spots that you're over in 10 years that don't include this nonsense. 5 if you're including when he decided that, hey, maybe we have a problem and we shouldn't be buying mortgages on houses. Then you come here and you're in that same exact spot right now. Every single one of these led to a pullback. I have a hard time using this again, and I've explained why. I'm not going to bore everybody with it again. But I think that's a very important note that we should pay attention to. And this is something I do think that we should follow up on. I think this is absolutely glaring. And this shows really and ties us into smart money, dumb money. And I think that's something that we should cover. In front of us, we have smart money, dumb money. Now, as we all know, we refer to this as institutional, and we refer to this as retail. And I think that's a much better way to look at it. If you take a look down here and you look at the blue line, well, our blue line is going to be for smart money. What is important about this? Institutional. Just remember that for a moment. Here's your institutions, and here they are, and institutional selling is pretty washed out. Now, what happens during this period when institutions start buying? When institutions start buying, we can start to see somewhat of a sell-off during that period of time. It's usually a sustained sell-off because they're out there buying for what? They're out there buying for more of a fundamental reason than a trading reason. If your pockets are deeper, you have to start thinking a little bit longer term. It's just the way that it is. Let's clean these off because we'll drill into this a little bit more here. You can see our lines right here, and let's just go through what these lines are representing before we start. This is if you are overly optimistic, meaning if smart money or dumb money is over this line, they are overly optimistic. I want to be really clear. It's not the movement that becomes the problem. It's not if you're over that becomes the issue. It becomes when you roll back through the line that tends to become the problem. Now, we'll get into that, but this is overly optimistic. This is overly pessimistic, meaning they're net sellers if you're down here or you're net buyers if you're up here. Now, if we just take a look at smart money for a second, or institution, what are they doing? You can see right here, we broke that line, bounced down, tried to get over, could not get over that line, bounced down. Now look at where we are. So crossing that line. So what we would want to do is we'd want to look at when we're here and what has transpired during that period of time. Well, we're here. Well, we kind of peaked when we crossed back over that line until we got to the top here. When we got to that peak, well, that was pretty much it. And then what starts to happen? Well, retail plays catch up in that situation. And you can see that here, if you peak, and then retail starts coming in and buying, and then institutions start puking. All right. So we look at that. It's not the peak on smart money that's the issue that would give us an indication that we might have a problem. It is when you break the valley and you break over this line. Now, it's not exact, especially when you're injecting $1.7 trillion in the market, as is what happened here when everybody thought they were really smart. What we have to do is look at this and figure out what else is this telling us? Well, this is telling us that we have not been over this level on dumb money or retail for how long? We've not been there since here, and then here, here. Okay, what are we looking for? We're looking for patterns, and then we're trying to figure out if we can ascertain what's going to happen based upon those patterns. I would argue in some cases that you can. In this case, if we take a look at what happens when dumb money is crossing here to the downside after being optimistic, and let's walk through again what this is, because it's really important to understand what things are, because when you understand what they are, you can benefit from it greatly. This is overly optimistic. If they're overly optimistic and then they go and they get to a point where they're not so overly optimistic anymore, it might be something to watch, starts bouncing, bouncing, bouncing. In this case, institutional stepped in, and they stepped in at such a pace that it really just kind of overshadowed what happened with retail. We're not seeing that so far. And the drop seems to be a little stronger here as far as what they're doing. So that is definitely something that we're going to want to watch. The other thing I think that we really need to pay attention to that I think is kind of glaring is if you come up to the top of here and you come across here, I'm just going to use this for a moment. Look at that level, how extreme that reading is. And that's a 3-year reading. So we take a look at that reading, okay, well, that's 3 years. What if we went back further and looked at that reading? And we're just looking at the dumb money for a second and looking at that reading. And then just drawing straight across again from that reading. And all we're trying to do is just, again, we're just trying to get a sense of where we are and how extreme this is. And we're going to come across. Okay, this is still pretty much an extreme reading for 5 years. And again, all we're trying to do with this is get an understanding. Okay, so this is a pretty extreme reading for 10 years, we could say. And by extreme reading, what do I mean? I mean that this area right here and here and here, well, for retail to be this overly optimistic has really only happened 3 times in 10 years. Well, now that starts getting interesting, and that seems like an anomaly. Maybe we're missing something, so we go back 15. And we see if there's something in 15 that could kind of allude to the same thing. We just come straight across that same level right here. And you can see, okay, well, 2009, 2010, we started getting a little frothy too. Okay, so now you have about 4 or 5 times in the past 15 years. And what you're trying to do is you're just trying to see how wacky what's happening now is in regards to the grand scheme of things. If we go out 2 decades, what you're going to notice is in 2 decades, you really have not gotten here. You've only gotten here in this particular period of time, here 3 times when you had the pandemic, and then once here. That is really it, that you've been that frothy. And if you take a look at that, there's no clear indication one way or another on what's going to happen. But what I will say is that the spread pretty much tells you a pretty interesting story. Now, if you want to get into the spread a little deeper here, we just go into the 1 year and we look at this, and you're basically looking at Jaws. Now, this is pretty simple stuff. When smart money or institutions are at the high end, we're in a much better position. Now, what I mean by we're in a much better position is right there. You see how you crack over that level? Well, once you start doing that, you're in pretty good shape. Once you crack over here and retail stops being overly pessimistic, what happens? You start getting into a good shape. What happens when we get overly optimistic to we're going to go to neutral? Okay, we underperform. Overly optimistic to neutral, but higher than we even were here. Okay, so we're probably going to underperform in the S&P. And not only are we probably going to underperform in the S&P, and that's according to this one statistic, but if we go back on a decade, the underperformance could be something along these lines, not something like a pandemic, but something along this little spot like here. And I guess we can just kind of go take a look at that really quickly and drill into that so that we can kind of see what's really going on there and you get a better sense of it. Let me just pull that back there. And then we can kind of really get in there and look at it. All right, great. Here's your level where you came back in 19. Obviously, this is pre-pandemic, $1.7 trillion injected into the market, which really skews all this data. It makes it very, very difficult. But if you take a look here, you can see that little level of underperformance right here. For us to say that this could be a signal of underperformance, that is something that we could definitely say this is something that we could say is going to happen, and it is something that we could be paying attention to. And I would use this. I would use this as a guide. It wouldn't be my be-all, end-all, but this one little symbol, the fact that we are at a level that you have not been for 10, 15 years besides a pandemic, a global pandemic, and now you've gone from overly optimistic to, maybe I'm not as optimistic as I thought. Now the question becomes, and you have to remember this one part of this, retail always moves faster. Retail's always in a hurry. They got to get in right away. Institutions, they move very, very slow. When you see institutional movement, you'll notice it's a lot smoother, where retail movement is what? Way more erratic and way more jagged. So now that we have an understanding of a couple core things. Number one, we have an understanding of what's going on with the indexes. We're able to talk about that pretty emphatically. We can talk about what's going on with insider buying, and we have a lot of oscillators that we look at that are telling us a couple key things that we should really, really hammer home. So we're seeing some cracks. bottom line. And we've gone through why we're seeing those cracks, but it doesn't mean that everything's just going to fall apart here. So I think that's a very important distinction. What we're going to do is we're going to go through a bunch of names that I'm looking at that I am either in, or names that I think have potential, or names that are telling us something. I'm going to do it in alphabetical order for no other purpose so that you can sort through this. We always have somebody that does the timestamps on these, so always check in description, but this will be in alphabetical order, obviously starting with A. And the reason for this is just, it makes it simpler for what we're about to do. So if we look at Apple, we see the crack. If you're looking at trying to buy Apple, the very first thing that you're going to have to do is get over this hump. I am short Apple. I have puts on Apple, and I also have an Apple Bear ETF. I am loaded for bear on Apple. Why? The 12/22 crosshair is very clear. Breaking the 50 is very clear. They missed iPhone sales. Go take a look at the last time Apple missed iPhone sales. This fits perfectly into what we were just talking about, deflation. And that is the concern, the more that I look at the data, that I'm starting to agree with. And obviously we talked about this, but if CPI is dropping, but PPI is not dropping as fast, well, that means that the margins are going to come in. If margins come in, corporate profits come in. Corporate profits come in, PEs contract. It's all connected. So comment on that, because I can actually do a whole video just on fundamental analysis, and I think it might be helpful so people can understand this. So these are the areas that I'm looking at now. The beauty of doing these on Saturdays so that we have the week ahead is that we can see on a weekly chart what the heck happened. Well, this is what happened this week. So no matter how you want to look at this, this is where we're at, and this is what happened. And you can see we broke down, you had follow through, and now you're sitting on the 22-week, and the RSI is below. There is nothing redeeming about this chart, nothing. Now, if we look at the weekly, and we want to say, well, we're going to hold here. Well, we didn't. So now what? Well, they start walking you down. Well, you broke there. Where would be next? The top. This pattern is everything now. See this gravestone right there on the weekly? All right. See how you're sitting there, 176.64? That is something that you're going to want to pay attention to. I don't know that we're going to break down right away, and I'll show you why I'm saying that in a moment, but look at this. You're setting up a bear flag. You could sit here for a couple of weeks, go across, form a bear flag, and then break down. If you break here, the floodgates open. If you break this level, 176.64, you might want to mark that off. Okay, I think you're heading to 157. I think that's where you're going. All right, that's my opinion of it. If you look at this on the hourly, we get off the pre and the post, and we just do something very simplistic as, let me just show you this with these clouds, and take out the short-term cloud and take out the 20 EMA and just look at the long-term cloud. There is absolutely no reason that you would even consider going near this. You can't even rally above that cloud, and the cloud's getting wider. Just one way that I would look at this. Something else that you could look at, and I do think that people are going to get frustrated shorting this. I do. But there's something going on here that we really need to pay attention to that I think is absolutely glaring with Apple. It's why I'm spending a lot of time on it. We were completely oversold down here at 14. We got to a 6 on an hourly. That is an insane reading on an hourly chart. I mean, if you were to look at that reading, you don't have anything like that in the past 18 months. I mean, nothing is like that, not even close. It means two different things. One, it means that the stock's probably in more trouble that you think, that it got that kind of pressure on it. And two, we should have a massive bounce, which I thought we were going to have back to the 55, even though it was short, it was going to short more there. What happened? We got back through the 30, got all the way up to the 40, and all we could muster was 80, almost 81. If you're long, that should scare the living heck out of you. So I'm not so sure that we're setting up to break down here, and we're going to speed through these a little bit faster now, but I'm not so sure we're setting up to break down here as much as we're setting up to form some kind of flag and then go from there and allow these moving averages to catch up, which will frustrate the option players. You might want to listen to that part that I just said there again. Please comment on the length of this video. It's going to be a little bit longer than normal, but there's some things here we need to talk about. So what they are doing is they are frustrating the living heck out of put buyers. I know this because I am a put buyer in AMD. And what they're doing is they're ripping us up, and then they're breaking it, and then you're like, oh, well, we're clearly going to go this time, and then they're ripping us up. What I would suggest is that you put on your 22 hat. What do I mean by that? You've got to start shorting the rallies again, guys. You have to start shorting the rallies into resistance points. That's what's working now. Buying these dips, yeah, that might work, but you better be darn quick about it. And if you take a look at what's happening here with AMD, and I'm using this one for a reason, you gap filled. You broke below that gap fill, and you closed over, so you never had a confirm. I broke below the other day. I better get back over this, because if I make a lower low here, it's on. So I would watch this very, very carefully here. And if you look at just the very simplistic things, everything's rolling. Everything is rolling. And we've already cracked here. We've already cracked on the RSI, so we're aware that we already cracked on the RSI. Go take a look at the weekly and you can see what's going on. Now, there are some signs of some stocks that you want to buy. I'm going to give you a quick tip that you should listen to, and if you are a short-term trader, you're going to want to pay attention to this. Run a scan on relative volume of options over 10x, meaning that they're trading 10 times their relative volume over 90 days. If you run a scan like that, you're going to find these little gems. So we found this array. I didn't do this. We had some people in the room that did it. I just had other things I was doing. But you broke out, and now you're flipping. You had huge buying in this in options and calls before earnings. And I'm not suggesting to do that. But you're seeing that break. This looks beautiful. I fully expect you to continue to push here. You have a lot of room here to run if you can get above this. You have an enormous base here. And what you're going to see when you go through periods of correction like this is you're going to have one it will lag, but it will lead. In other words, you'll see IWM lead. And why is that? Because smaller caps are not as linked to macro. So names like Array, those kinds of names could move. I would start being really careful of Boeing. Now people say, well, why? Boeing crushed, and now I have this flag. Do you? Is that what you have? Or do you have a bunch of wicks, and we know wicks are what? Price rejection. Doji tries to break the doji, can't do it. Dragonfly should break the dragonfly, breaks over, pulls back, gets you in, breaks down, gets you in. This time you're definitely going to go wick, wick, wick. What happens? Rejection. Now you're closing below the 12. If you just did a very simple short-term indicator, I'll show you this one. So this is the 3, 5, and 8 on 15 minutes, but these are daily moving averages. Look what's happening. The 3 and the 5 are crossing. Does that look like something you have to run into? Can you see, for those that are familiar with my patterns, I have one that's called devil horns. You should be able to see that very, very clearly here. Here's the horns, here's the face. As I know, people will comment that I have issues, but there it is. And then here's your neckline. You can see it's not really a head and shoulders. So you're breaking there, and then you can see how you could come back down to 232. If you go through deflation, if the dollar comes in, which very well could happen, and I know we can if all over ourselves, but if the dollar comes in, this is the dollar on a weekly, and then let's just get rid of this and go back to this real quick. If the dollar comes in and keeps dropping, that's great for us. For Caterpillar and those names, because Global will want to buy more Caterpillar machines because the dollar is weaker. If deflation kicks in, it's another issue for companies like Boeing and Cat and those kinds of names. Now, we talked about energy. We talked about insider buying on energy. This is a name that if you've been with the group for a while, you've been following me for a while, you're fully aware that this is one that I really like to play, and this is just a trust. I just want to point out the obvious. You are back above this on the weekly. You're back above 30. You're back above the 22. You're starting to push and get over here. These are the kinds of names that all of a sudden, out of somewhere, people will say, well, why is that going higher? Well, it's going higher because energy prices are going higher. So I'm going to just say this. In I won't go back that far. I'll give you this one. In 2003, I am shorting Exxon, and I'm shorting the heck out of it because I'm smart, and we went to war. And I'm being facetious, but so we go to war and then we win the war. We're going to win, Operation Shock and Awe. For those that don't remember, I'm in my late 40s, so you know where I'm going with this. And so we're short the market and we're killing it because we're really smart. And then out of nowhere, as we're short, what starts to happen? Well, all of this starts to go against me, and I can't figure it out because oil should be free because now we're into Iraq and oil's going to be so cheap. And I remember watching Soros and these guys buying the living heck out of these stocks. I didn't understand geopolitical politics. I didn't understand what was going to really happen in Iraq and how this was going to fragment the OPEC. And that's exactly what happened. There is something going on very similar to these names here now. And that is what's happening with Russia and Ukraine. And it's funny because people will say, well, how do you know that this might affect it this way? Because I got my butt kicked 20 years ago. That's how I know and I remember. So if I look at these kinds of names, I would start paying attention to these because they're telling us that oil prices are going higher. Goldman has mid-90s to 100 now for 24. And if you think about that versus where you are, that's a big, big number. That's a really big number. And that could lead to pressure pricing pressure, which could lead to deflation on other items. See, it's all connected. So BPT is one that I'm looking at. The other kind of sectors you should be looking at are these kinds of names. Now, I'm not telling you to marry this. I'm not telling you that we're going to have deflation, but the car industry is going to be fine. That's not what I'm saying at all. What I'm saying is rally tries to break. Rallies tries to break back to that secondary level. So this is where the secondary got filled at the money finally, when they were able to fill it. Look at what's happening here. You're holding again. Huge short positions. Go and find huge short positions because they are the ones that are going to be squeezed. These are very quick trades that you need to do, not long-term trades. Why are they quick? Because the shorts are going to cover these because there's so many other better shorts out there that I'm going to show you what I mean by that in a moment. But now you're back at this level. We can overlay all this. Again, I'm not telling you to marry this. What I'm saying is you're probably going to get back to 45 fairly quickly here. Okay, because people here, first, this is a piercing pattern. I could do a video on that. Comment if I should start doing more videos on actual patterns. I am a pattern trader. It might be helpful. I've done some videos before that are pretty good, but I'm better at making these videos now. So you should get back to 45 here. I think you'll at least get a test there. And I find it very interesting that you're holding here short positions, stocks that people are short. Look at DraftKings. Look what it did at the 55. These are the names that you want to watch. Run scans on the 55, find out ones that are near it, held it, or broke it. Pay attention to those names. Huge short interest. People shorting here on the Barstool out ESPN in news, which I actually think is very good news, quite frankly, for ESPN and Disney, but apparently I'm the only one that's starting to think that with the way Disney is trading. So if you look at this, I would look for these kinds of moves. I've got and this is what I mean when I said earlier that you want to see an emphatic bounce off the 55, right? We didn't get this with NVIDIA. You got, womp womp, where we kind of held, but not really. Okay. DraftKings was like, no, we're holding. We're stopping right here. That's enough. And that kind of ties right into what? Ties right into the support level. That ties right into a bullish engulfing sitting right on the 55 that could push you up to here. I'm not telling you to marry these things. I am not telling you you're getting the new highs. What I'm pointing out are short-term trades by traders that could be squeezed as they get out of those names and rotate into more lucrative shorts. Disney, I'm just going to say this. I think that he did some really good things on that call. The most troubling thing that I see is that they're not fixing the problems that got them where they were. I'm going to leave it at that. They're not fixing the problems that got them where they were, and you lost 12 million people in 3 months, and you're raising prices. If anyone knows this, if you had a business and you were selling tacos, and all of a sudden, all the people that you had that you were selling tacos to, you lost 20% of them, or 10%. You lost 10% of them in a week. You would notice. Hey, we usually sell 500 tacos. We sold 450 tacos. I know what we need to do. Let's raise prices. It defies. So there's some things they're doing very well. There's other things they are not. Monetization of ESPN is sickly brilliant, in my opinion, and has been a long time coming. And I think that's very good. But we'll talk about why it's probably bad for PENN and what it actually told us there. I wouldn't do a lot here with Disney. I would watch him wait and take a much longer term approach. Iger's a winner. I have a real hard time not betting on winners when it comes to people, but I don't know what you do there technically. I want to show you this because this is what you're dealing with. You're watching companies break down that beat earnings by 200%, that raised guidance and earnings for next quarter, and they're breaking down. 1, 2, 3. You are below the 55. In 2 weeks, that 22 is going to cross the 55 if you're here, right? You can just calculate where they are and how they're moving. So we know that that's coming. So what the heck is going on there? That's not something you can really just dive into. Well, they're blowing out high beta. It could be because of deflation. It could be because the downgrade of sovereign debt. I don't have all the pieces connected yet, guys. When I do these, you can tell that I'm kind of riffing this. And I'm just speaking out loud as to what I'm thinking. So I think that that's really poignant there. And I would pay attention to this because this is telling us something. And I don't know exactly all the points yet, what it's telling us, but you can see where the money flow is going. And you can see where I showed you earlier where the insiders are putting their money. And remember how this works. When these insiders play, we want to look at insiders. Then we want to look at institutions. Then we want to look at retail. In that order, and that's why I covered the previous slides in that order, if you'll note. So here you are, and you're breaking that 55, and now you're down here. If you watched last week's video, and you've been following us all week, as I said, they're all linked. I said 418, I was off. We're still short this. We're doing exceptionally well with the short. We are short this. I have puts. I'm short stock. We have this NVDS. I want to just say something about these. People will stay away from them because they're cheap, and I get that. Understand that these are calculated daily. Okay, daily calculated. What does that mean? That means that if I drop 5% today, I'm going to add 5% to this, or in this case, 1.25, 6.25%. But what does that mean going forward? Well, that means a couple things. Number one, the next day, if I'm at $10 and then I drop 10%, I go to 11. If I drop 10% the next day, I go to 12.10. Okay, these compound. That's what makes them so vicious. So I would spend some time, if I was you, going through these. I don't know what NVIDIA is going to do on earnings. I don't know that it's going to matter, quite frankly. Okay, if you start seeing PE compression, it's not going to matter. It just won't. And I'm going to give you an example. Everybody remembers my three-legged stool. We have a lot to go over, so I'm not going to draw it again. But I just want to go through this so people get this. Okay, here's Cisco. Cisco makes 4 times in revenue here what it made back here, and this is where the stock is. All right, remember that. This is what happens. Let's get to it. So here we are in the weekly. We're breaking the 12-week moving average. Where's major support? 350. Well, you can't possibly get there. You could be there in a week, guys. You take the stairs up, you take the window down. This crosses that 70. How'd that go last time? Not too well. And that's the beauty of when you get over. You don't sell because you're over. You sell when you break back under. Remember that. So I like that NVDS. We're still in it. I think we're up over, I don't know, I think we could be up over 20% in it now. I'd have to do the calculation, but we're doing well with it. And the one thing I like about these smaller ETFs like this right now, I'm just going to say this, these types of things will keep you in the trade with, they're priced low. There's no expiration to them. So you can leave them on with the trade, where the options, they are just tearing us apart on the option side of the market. They really are. They're just, it's too choppy, and you're wondering why you're not making money. It's the implied volatility that's in the option that's absolutely crushing you. So what they're doing with the VIX, I mean, it's all feeding upon itself. So then you look at NXPI and go, was that the next one? Well, it kind of fits the criteria of possibly the next one, doesn't it? Now, how could that one break? We had great earnings. They gave great guidance. If you're going to go through PE contraction based upon deflation, none of that's going to matter. So that puts us in this different situation. And that puts us here again. What are we looking at? That 12, 22 cross, 55. See how all this, once you get it, see how when you connect all this, but where are we going? I don't know. Maybe we're going to 197. Maybe we're going to hold 55. I have no idea where we're really going. Nobody does. If they did, they'd sell their house and put it in the idea, right? What we have is probabilities, and that's what we have to do. We have to play with those probabilities. So you can see where you're at right here. Maybe we hold 197. Maybe we don't. I'm looking at this very clearly, and I'll clean all this off, and I'm seeing a left shoulder, a head, a right shoulder, and a neckline, and we just broke. And what you do with those necklines and head and shoulders is you just measure these patterns from here, 7%. Again, please comment on the length of this video because it's going to go a little longer because I have a ton to go over. This is going to be an enormous week for us, absolutely enormous week for traders. I'd start paying attention to names like Oxy, Why Now? A couple things. Go back to this chart and we'll start here. A couple things. All these moving averages are finally starting to turn up. We're constantly staying above the 50 on the RSI right now, which is pertinent to me. Let's clean all that off again. And you can look at these levels, but watch this on the weekly. See? So in other words, I've held, and we know Warren's here. We know that's where he buys at 56, and you're setting up to break. You broke the DTL, and what haven't you done since you've broken these DTLs? You have not flipped above a higher high. Now you have a major one right here, but that's going to get you to like 71. Do you really want to wait for that? So watch if you flip there and then go from there. PENN, we should talk about this. Now, if you look at this on the weekly chart, and let me just pull this up here. There we go. If we look at this on the weekly chart, PENN, after hours, we were talking about this one in the community. If you're on the wait list for the community, you should be getting an invitation this week or next week. We had a lot of people that recently signed up for it, and you will be getting an invitation shortly. Just bear with me. It is a one-man show, and I keep it that way on purpose. It's just the way that we do the room and the culture. It's an actual community. So you can see here and how we're, right? We break. Okay. Why? They got rid of Barstool. Well, wasn't that good that they got rid of Barstool? Well, how is it good that you paid $500 million for something and you gave it back to them for free, and you're trying to spin it? Well, he was too flamboyant. Well, you didn't know that before you bought it? You didn't know what he was like before you bought the thing? Well, who's in charge? because everybody knew that. I mean, it was pretty clear, what the guy did, and he's sickly brilliant, right? I mean, I don't think anybody can knock that the guy's brilliant in what he built. Whether you like him or hate him, I don't really care, but you can't knock what he built. So then they give him the company back with non-compete, and if you ever sell the company again, which he never will for obvious reasons now, but if you sell the company now, we get 50% of the proceeds and a non-compete, and you can't open up a sports book. Okay, right? But they can't stop them from advertising. They can't stop them from licensing deals. There's all types of things that they're going to be able to do that we don't understand. And it doesn't really matter. Let's say they can't go down that road. Why would you give this back? The only reason you would give this back is you don't want to outlay the expense of marketing it any longer. It didn't work the way you thought, and so you realize that it's a net loss leader the way that you're going, and you're trying to preserve capital. So we started talking about that this day. It was after hours, 31, 32. We started talking about this as kind of a short idea, and then lo and behold, what do? They do a secondary here. Well, who does a secondary when you're making money, right? So here, why do you have $3 here? Why are you here with 13 cents? When you really start going through this, right? 70 cents, 14 cents, why do you need to issue stock and dilute shareholders for proceeds if everything's going great and you just partnered with ESPN? All right, so we're missing something here. There's something that we're missing here, and I think that this is setting up to go a lot lower. That's where I'm going with this. So I would watch this level very, very carefully, this 23 level. Maybe you bounce after that secondary. Maybe you don't. I'd watch how that secondary goes, watch demand for that secondary, and go from there. SLB is one that we're doing okay with. This reversal the other day was huge. You're near this high. I really like the way that this is acting. I would really tell you to focus on these kinds of names. This is really where we're going. Okay, we're heading towards oil. Again, I don't have all the pieces connected yet. I think it's becoming very clear by the way that the media is changing their tune on Ukraine and Russia. That is wrapping up. Ukraine has reached out several times apparently to Russia to have peace talks, and Russia is saying, yeah, not any longer. We're not doing that any longer. We don't want peace talks now. So, that seems to be coming to some kind of conclusion. And when you see that, I don't understand why we wouldn't think oil prices are dropping, but they're not. And Russia just cut production. So this might be something that Russia does. I don't have all the pieces connected. I'm not that smart with it, but I would start looking at these oil service names. Let's talk about SMCI, and we talk about how we take the stairs up and the window down, and you want to pay attention to this. So this is one that we were short in the room. And I want to go through why, because I got a lot of questions on this. So here's the 55, and you held. Usually what you will do when you hit the 50 is you will bounce emphatically off of that 55, okay? And we just saw that. We just went through it right here, right? Where that is like, there's no question that that's a bounce. If someone said, show me what a bounce off the 55 looks like, this would be in the textbook, right? Okay, so we know that. Now you go look at this SMCI, and we bounced here. And I shorted into this that day that it broke. I made $5 on the stock, and then it just went against me, and then it wound up going up. But I really wasn't overly concerned, and I held the position overnight. I did trim some of the risk and then just put some of the risk back on. Now, why? Well, the number one thing that you have to look at when you have this and say, did it bounce? The number one thing you want to look at is come to here and go, did we close 50% over the preceding bar? You might want to remember this. Did we close 50% over the preceding bar? No. That means that the people that are in there, on average, did not cover, did not buy back. Oh, okay. Well, that's somewhat interesting. But isn't that a bullish harami? And people know that I trade bullish haramis. Clean all this off. Yes, that could be construed as a bullish harami because you're not 50% up. You really need to be 25% of that bar. But I did a whole video on this. It's linked it's linked somewhere on videos. But if you look at that, so okay, well, that would become my stop. Now, what do they do to you the next day? And this is kind of what I thought was going to happen with PPI. I actually thought PPI would be better, not worse. But that led to the selling of the indexes as we went over the possibility of deflation. What do? They gap you down $9 from the high. Okay, so the people that bought at the high are now down $9. How about the people at the close? How'd they fare? Not a lot better. Now they're down 6, okay, off that. And they actually gap you to here. So you know what happens. You hope. How's hope work? Doesn't usually work for you. They gap you in the middle here. And then we just had a field day with this on Friday in the room. I can walk through it and we can talk about it. And again, you want to plan this stuff out the night before, guys. You don't want to be looking at it that day and making decisions. And please make sure you do comment on the length of this video, because I know it's going to be a long one the way I'm talking. But there's so much to cover. There really is. So here we are, and you can see, well, what did we do here? This is the easiest trade in the world. I mean, there's a 1 minute bar. Here's the doji, like the wicks, I should say, not a doji. Tests, what do they do here when they test, right? Let's talk about this stuff. What do they do here when they test? They're looking for what? They're looking for stock, because you bought here, right? You bought that, and then they trip you, and they get your stock because you bought off the 1 minute open. So they take the stock from you, they run it back up, they're unable, then they cut it down 1, 2, 3, right? 3-bar pattern, and then you just never come back. All right, really textbook kind of stuff, never able to get above critical levels. If you go and take a look at these critical levels, once you cut them, that was it. And you just got signal after signal. You can see it right here, right? All day long. That's great. Where's this going? Okay, so the question is, where is this going? And this is what I'm getting to. I don't know how you're looking at this and just assuming that's going to bounce back, because it's such a great company. These were the revenues. These were the earnings. They are okay. They don't warrant this. Just so we're clear about this and you understand where you went. Okay, they don't warrant a 200% move in a quarter. Okay, they don't warrant 127% move in a quarter. Maybe you could have been up 20%, but it doesn't warrant that. I mean, you went from quarter versus quarter, you went from 1.2 or 1.4 billion, okay, to 2. Okay, that's great. You're crushing it. That's not 200% growth. So everything got ahead of itself. It doesn't mean that it's not going to work. It doesn't mean that AI is dead. It's the dumbest argument in the world that AI is dead. You got ahead of it the same way that we got ahead of Netscape in 95. And then we didn't know what the heck to do with Netscape. And then by 98, 99, we figured it out. This takes years to unfold, not weeks, years. We need to stick with the theme, but we also have to deal with the, what's actually happening. I don't see how you're not testing this 214, 215 level. So I'm still currently short and I'm still holding it. That's a 3-bar pattern on a daily. I probably really should do a video on that pattern, but that's really hard to deny there, guys, what's going on there. And that is a very clear break. And now I'm below 50 on the RSI. But they're not all doing this. Now, if you watch this, this is one that we've been going over here for about two to 3 weeks. We've been talking about these names. Land trusts, just like BPT. I don't understand all the oil and how that's transpiring and all the moving parts and why this is happening. And you're welcome to comment below on it and link articles below that you think that I should read so I can understand geopolitically what the issue is. Is it that Russia is going to cut more supply to kind of teach the West a lesson? I don't know. Is OPEC going to go along with them? I know OPEC's not very keen on the US now. I don't know. I don't have those answers. I do know how to read a chart, and I do know how to read when something's turning. This was turning, and we got in this, and we're up about $200 on it now, which is just an absolute windfall. And how did I'll just tell you one of the things that was very glaring to me on how I looked at this, and this is why I always laugh when people will say, oh, well, RSI is a lagging indicator. Well, it might be a lagging indicator for you. Doesn't mean that it is for me. We talk about this all the time. You give me a hammer, I can barely hang a picture. You give it to someone that is a skilled craftsman and they will build you a house. So you see how you're turning right here and you're starting to break down? Look at your RSI. Did your RSI break down? Oops, grab that right there. Did the RSI break down? No. The RSI gave you a positive divergence. Is that a leading indicator or a lagging indicator? It is very clearly there a leading indicator. That is not refutable. Now you could say, well, go show me that 1,000 times. And you actually could go and find examples of that. But then you flip the doji and then it was on and then I just went to confirmation and I didn't really want to buy in front of the quarter because I didn't have an edge. And if I don't have an edge of at least 10%, I'm not buying in front of a quarter. Beat the quarter, reverses, pops, it's go time. That was it. And we've done exceptionally well in it ever since. Don't sleep on this if you missed it. These kinds of names can keep going. When they start cycling these trusts or land trusts for oil, they are a cycle. It is not a couple weeks. It could be years where these things just keep pushing. And that's why in our community, I don't even have this as a swing trade. I have this as, we break them down by position trades, swing trades, day trades. This is set up as a long-term trade where I'm looking out months. I am not even looking out days or weeks. Now, if something changes, I'll act. we should talk about Tesla. Now, we've been talking about this for some time, this breakdown, the bear flag, and what's going on here. The gap down, and here we are. Now you're forming this hammer. Look, all they're doing is playing with you in here on the option side. And maybe you're going to catch this bar. Maybe you are, but you're broken the 55, so it's game over now, okay, until this can get back over the 55. And I'll be net short this until I can do that. That said, you have a gap in the chart here. You're holding that gap. Maybe you get to 235, maybe. But let's take a couple steps here on this and just go through this really quickly and look at this on the weekly. And again, this is why I said this is going to be there's a ton of stuff in this video, guys. You're probably going to want to watch it a couple times, or at least mark key levels. Look, you're breaking the 12-week for the first time and you haven't done it since May. You don't think that you're going to come down here and test like 215, 220? I mean, it's a lock. I would strongly suggest that instead of getting whacked around and chewed up by options, that you start looking at these. All right, TSLS has not been over the 55 since back here. Okay, I would start looking at these versus playing with options right now, guys. I think it's so much easier now because they're so depressed versus where they were before. And if we really start cracking, and again, as we stated, this was day one on us breaking on the Nasdaq. This was not, we've been down 4 weeks. This is day one of a close under. It has not been weeks, it's Friday. Keep that in mind. And you're seeing this all over the place with TTD, great earnings. What happens? Breaks the 55. Well, surely we're going to bounce back through that. Nope, down again. Now you have gaps in charts. They can't get out fast enough. Names like UPST, you can see this clearly right here. We actually did really well with this, and then we just got stopped out. But names like this, they're just crushing, absolutely crushing. And the slightest hint of anything being wrong, and they're destroying it. Look at WYNN. WYNN was another example of a great company, and there's a bunch of them that I can go through. It's another example of a great company with a great quarter, and they're crushing it. And we have to look at sentiment as well. And what do I mean by looking at sentiment? If I have good news and I'm breaking down, that is bearish sentiment. If I have bad news and I'm going up, that is bullish sentiment. Keep that in mind. That's it.